Hindustan Zinc is known for two things: great profits and much greater dividends. It all began in 91-92 when 24% was sold by central government to financial institutions, and after another 10 years the government went for disinvestment, got the company valued at 1712 crores. Vedanta won the bid, got 26% from government and 20% from financial institutions. The company became a non-government company. In 2003-2004, as per the purchase agreement, Vedanta bought another 19% and central government was left with 29.5%, which it could not sell for over 20 years because of pending litigations. Recently, in November 2021, it got permission from Supreme Court to disinvest. Vedanta at the same time is not exercising its call option to buy the shares, and therefore there will be offer for sale most likely before March 2022, when Vedanta stays at 65, others will come to 35%. In these 19 years, the company has paid dividends of 66,000 crores and the market cap has moved from 1,700 crores to 1,33,000 crores, giving an IRR of 34.5% and a 19-year CAGR in the market cap of almost 26%. Such is the greatness of the company that even after 2 decades of losing the bid, Mr. Kumaramangalam Birla regrets having lost Hindustan Zinc to Vedanta. I am Vittal Prabhu, bringing you the weekly video on Stock Learning Simplified. Hope you will find the video useful and effective. Hindustan Zinc is into exploration, mining and smelting of zinc, lead and silver. Incidentally, silver is a byproduct and its customers are from various industries: automobile, consumer durables, construction and infrastructure. Hindustan Zinc has got long-term contracts on zinc reserves. Its mines can last for another 24 years based on current consumption. Privatization helped it with latest technology and strong business processes. Its operations have remained quite efficient, and in the market it has a dominating presence with 77% share. Because of the location of mines, its entire business is confined to one state, Rajasthan, and as a mining operator, it naturally faces regulatory and environmental issues. Cash flow of Hindustan Zinc says it all. Operational cash flow quite sizable. Working capital changes nominal and under control, but it is disastrous to see hefty dividend going year on year disproportionate, which results in operational deficit every other year coming up to 31st March 2021. And over and above this, the company has to invest in its infrastructure and fixed assets, which is quite sizable. And as a result, company borrows heavily, and that results in additional interest. And the recent dividend, which is paid after 30th September, is another 7,600 crores, pressurized on liquidity, and the dividend is quite phenomenal, and the company's bottom line collapses under the pressure of the consequences of hefty dividend. The dividend flow is quite interesting, starting from 2016 till 2022, that the profit distribution as a dividend is crossing 100%. It is 172% in 16, 179 in 17, and if we take 7 years period, we find average profits is 8,170, whereas the dividend is 9,540, 117%. And one is surprised, the prescription of dividend policy as higher of 5% of operating net worth or 30% of NPAT, and there is a big disconnect. Hindustan Zinc has inherited a strong net worth, but because of the indiscriminate payment of dividend, there is impact on the net worth and also the borrowings. Net worth has fallen, the gap has been filled by borrowings, recent one being NCDs of 3,500 crores and bank term loan of 1,500 crores, all to be repaid within 3 years. And the compulsions for this can be traced to the shareholding of the company. The abnormal dividend story can be explained through the shareholding pattern. Vedanta Limited is the holding company of Hindustan Zinc with 65% holding, and Vedanta in turn is owned by Vedanta Resources to the extent of 65%, others being institutions. If Hindustan Zinc declares a dividend of 100, its 65% holder Vedanta gets 65, and Vedanta Resources gets 65% of 65, that is 42. But Vedanta Resources has got only Vedanta and Hindustan Zinc as its sources of income, and therefore it gets 42, but its commitments are more, with a debt of over 50,000 crores. And whenever it needs money, it pulls it from Hindustan Zinc in the form of dividend, which is legal and permissible. To enhance the source, they wanted to take Vedanta Limited as a delisted entity, but the delisting offer failed, for there was not enough bid quantity, and the price was also found to be unattractive by the institutions. In the meanwhile, whatever the company acquired in 2002, 26%, there were irregularities and accusations. Supreme Court has asked CBI to reopen the case and proceed with the inquiry. And of the 65% held by Vedanta in Hindustan Zinc, the group has pledged a quarter of it. And this adds to the risk profile of the shares of Hindustan Zinc, which will be subject to greater volatility. It is through the strength of its operations that the company has been able to build up a strong net worth. If we see revenue and NPAT on a trailing 12 months basis with quarterly depiction, there is no abnormality except for a fall in the NPAT percentage, particularly during the last 2 quarters. Even the gap between NPAT percentage and EBITDA percentage is widening for 3 reasons. Interest earned on deposits has reduced due to reduction in the volume of deposits. Interest paid has gone up due to borrowings, and there is additional provision on taxation. If we look into 5-year compounded annual growth rate, we find net worth has grown negatively by 3%. Surprisingly, receivables of the company on a 5-year basis show a CAGR of 30%, while the company's revenues have grown by just 8%. This is a matter of concern. You look at the share price movement starting from June 2020 till December 2021. The graph is positive and moving upwards, although after June 2021, from the level of 339, there has been a small fall. Overall, on 18 months, the return generated is 85%, which is quite impressive, but the sideways movement after June 2021 is not impressive enough. Growth in market capitalization has been quite impressive with Hindustan Zinc, moving from about 58,000 crores in 2016, more than double, to 1,33,000 crores as of December 2021. The PE is at about 15.4 based on TTM profitability. Upside possible, but there has to be confirmation from positive operations and liquidity normalcy restored by the company with proper corporate governance. Daily chart is conforming to the regular pattern of triangular movement periodically, resting on the 200 EMA, moving across 20 and 50 in the near future looks a possibility. The Fibonacci retracement level of 50% at 323 is acting as the immediate resistance to the movement of price, and it might prove to be a threshold before the price moves up to reach the level of 343, which is incidentally the 61.8%. Bullishness is quite evident in the placement of candles with an upward incline inside the Bollinger Band. A reversal movement in the oversold zone is a bullish indication in respect of RSI. In relation to the signal line, the placement of MACD is quite positive, but the crossover might take longer. Price action data in terms of trading quantity and closing price for the last 3 months is not throwing up any firm indications. The average price has shown a marginal fall of about 8%, and that is not significant. This fall is not accompanied by any increase in quantity. On the contrary, there has been a substantial fall of almost 70% in the quantity involved. As both price as well as quantity have been falling, there might be a better chance of reversal possible. A look at the quantity per trade and also the delivery percentage is suggesting no surprises, as the delivery percentage has remained almost constant on a 3-monthly basis. Quantity per trade, on the contrary, has gone down in size, which is a confirmation that it is more of non-speculative element which is at play in the market. Hindustan Zinc has remained a successful disinvestment idea, bringing fresh air and technology to the field of public sector. Dividends have proved to be quite disproportionate and hefty, affecting the liquidity balance, causing the company to borrow debts and bring additional interest cost. Behind the dividends are feared issues of corporate governance. Revenue growth has been muted, but the cost has been increasing because of finance costs. Price is supportive, giving good yields over a period of 18 months. Product monopoly, market support, strong operations. Hope you liked the presentation. You can access similar informative and rich content oriented videos at InfoCard on Stock Learning Simplified. We look forward to your likes, shares and comments. If you are new to the channel, may please subscribe and press the bell icon for timely intimation on our forthcoming videos. Thank you so much for your time, support and interest. This video is for purposes of information, education and awareness only. This is not to be a solicitation or recommendation to buy, sell or hold securities. Please seek appropriate professional advice wherever applicable.